First, I'd like to thank everyone for attending today's roundtable. We've come together because many of our nonprofit clients are facing the real impact of federal funding reduction. And at JMT, we work exclusively with nonprofits, so we deeply understand the challenge this moment presents. That's why we felt it was important to create this space, an opportunity to listen, learn, and share how each of you is navigating these uncertain times. Today is also about hearing directly from our panel of accomplished nonprofit leaders. We're grateful to have them with us to offer their insight, advice, and strategies for moving forward. And without further ado, I'd like to introduce our panelists. All right. So I'm going to go ahead and introduce everyone. So joining us, we have Julia Patrick. She's the CEO and founder of American Nonprofit Academy. Also joining us is Michael Gellman, founder, Fiscal Strategies for Nonprofits, and also Sustainability Education for Nonprofits. Also joining us is Paul Preziatti, partner with Johnson and Lambert, and as well as Jeff Young. He's vice president with First Bank. And myself, Buu-Linh, I'm senior VP of Financial Solutions with JMT Consulting. And for this roundtable, I will be the facilitator. So just a quick housekeeping. We are using Zoom. And we would love for folks to participate in this roundtable discussion. So we've got Kristen and Luke that will be monitoring. If you'd like to participate, we would love for you to participate, please. If you can see in that screen, there is the raise hand signal. If you click on that, and it will alert us that to announce you. And if you could just if you're announced, please, if you could just introduce yourself, state your name and the organization you're with. All right, I think we are ready to get started. We have a lot of topics that prior to putting as part of putting this together, but because we only have 1 hour, we limited our topics to 3 areas. And the 3 areas we'll be speaking to today is funding stability, banking institution support, and then lastly, board engagement. So we'll start with funding stability. This is our first discussion topic on funding stability. Best practices in scenario planning and cash flow forecasting during uncertain times. I'm going to start with Michael and Paul, if you can provide maybe some insight in this topic.
Perfect, Buu-Linh. Paul and I have been pairing up on this, collaborating on this subject a lot lately, although we've been talking about it for many years. And we want to talk a little bit about something that we are using both with our clients and in our presentations a lot. The planning, and the key word here is planning and cash flow. Is, Paul, don't you think the funding pipelines, they've always been out there, but now they're super critical? And I think I'm almost like, when I wake up in the morning, I grab my funding pipelines.
Mm-hmm. Yeah, especially if you're in an environment with federal funding, it's incredibly variable, and you have to go through multiple scenarios and multiple future paths here to think about what's realistic for your organization. And Mike, one of the lessons we learned, can't believe I'm saying this, over 5 years ago when the pandemic hit, was in times like these, cash flow analysis and scenarios, while I'm a gap financial statement guy, they can be even more important than financial statements in this time period. Wouldn't you agree?
I agree 100%. I mean, we always want to be aware of compliance and gap and all that. But right now, I think this is a bad word, but sometimes we're in survival mode. And I think and there's this conservativeness in accounting and finance where we always have to guard against the downside. And so what that means is that we have to plan that even if there's a possibility that funding might be pulled or adjusted. So Paul, I think I want to throw this out to you. The funding pipelines, I've always used them, but I think that makes them so important right now is that when you learn about something, then that doesn't trigger a journal entry. But the funding pipeline gives you a place that when you learn about something, you can do a best case, worst case, you can go ahead and make an entry. And it's not necessarily a gap entry. And, I like to explore that with people. What do you think?
Yeah, I think being informed about what your future holds goes a long way in today's environment, right? And it allows you to make critical decisions, whether that's about the workforce, whether that's about what other potential funding paths we're spending time pursuing. Because remember, all this takes time and effort. I think it's really a win for all involved. But the other thing I think about too with this Mike cash flow analysis, I think once a month at an absolute minimum, right? And for some organizations, you may even need to look at it more. Would you agree?
I agree. And if you go back, Paul, funding pipelines are not new. And I think they were there just to set the stage a second, that you're using them at least twice a year. And they're about 6 months apart. Once before you start prepping the next year's budget, take a look at your funding pipeline. I think that's really critical. And then I like to add a second one right after year end and to see, what came in, what was it different than when we had in our funding pipeline or our budget. But now I think they're a place where as information becomes available, and like during the COVID, Paul, I appreciate you bringing that up. We went from like twice a year to quarterly. And for a while there in the beginning, we were like down like on the fly, to use a hockey terminology. As we learned, things were happening so rapidly. People were pulling events and things. The funding pipeline, it's just focused on the funding, could enable us to do a quick best case, worst case. Are we having the event? Are we not? Is that grant, getting cut off and such? So, and Paul, I want to throw something back to you. The funding pipeline is not just the here and now. It's also down the road a little bit. You might be in the middle of a 3-year grant, right, Paul? And it's great. And we're okay with that. But, maybe that grant a year and a half from now might not renew. And so it gives you a chance to look at that.
Yeah, I don't think you can take anything for granted in today's environment. This isn't directly related, but I read a headline this week that the PCAOB might not be a thing anymore. And that's one of those things you take a step back and you say, wow, I would have never, ever thought that was a possibility. And I relate that back to the funding pipelines, Mike, that you can't assume 100% certainty with anything. You could say it's very likely it's going to continue, but I think with the variability of today's environment, evaluating all potential scenarios is necessary.
And Jeff, I want to throw something out to you for a second, but I was able to participate in a bank sort of similar to this, we had another banking people on. And, none of us can predict the future. We've learned that through all we went through COVID and inflation and, wars around the world. Everything is unpredictable, like hurricanes. But the one thing, Jeff, I don't think we can be caught, and I think this is very important, is we've got to do the best we can and try to visualize some planning for if the events change. You can't just say, I don't know, so I'm not going to plan. And then I think that's a little bit of a sin, Jeff, that you have to show your organization, and project confidence and trust. And so we were talking about in a banking environment, all of a sudden you have to reach out to the bank and we need help. And, if you could show that you've done some thoughtful planning, but to just sit back and say, I don't know, and throw up your hands, you can't do that.
Thanks. Well, you bring up a great point. I think in times of uncertainty, it's really when the whole idea of relationship banking comes to play. A lot of banks talk about being relationship oriented or that they do a lot for the community, but really you've got a relationship with either the entity of the bank or the banker. And what you really want to find out is, does your banker, are they an advocate for your mission? Do they believe in what you're doing? I find that the bankers that are really good storytellers when it comes time to making credit requests within the bank. If they have a history or they know your your organization and they know what you're in business to do, they can tell the story and act on your behalf for any type of credit request. And one of the interesting products that I haven't seen a lot of nonprofits use, I've got a handful that use this. It's what's called an officer guidance line. It's kind of an old school way of handling credit requests, but you can Google search what this is, officer guidance lines. But it's basically a commitment that the bank makes to an organization. And in the event of a rainy day scenario, it's a funding source that can be there for cash flow needs. So if you're predicting out, like Paul and Michael were talking about, sort of the forecast, good, best case scenario, worst case scenario, you can kind of figure out what that timing may look like. And if you've got the relationship already in place and you've got a bank that can stand behind you and you get something like an OGL in place, that can be a really good funding source. And the other thing that I would add too is if your organization has existing debt, now is a really good time to see if you can go back in and either recast the amortization schedule on term notes. That's a great way to try to save on monthly payments, or also negotiate the terms on any type of credit facilities you have, lines of credit. The other angle to this is analysis charges. A lot of banks charge that for your operating account, and not many people know that that is a negotiable line item as well that clients can take advantage of.
So Jeff, I know this is a little bit hard, but two things. Number one, funding pipelines work in the positive too. If opportunities come up and you can then play it out, the whole point is like in any budget, budgets are there and you work really hard to pull these budgets off, correct? But how long does a budget last? And I always say a budget lasts 3.5 seconds. As fast as you get it approved, things change around you. And so the funding pipeline allows you to look what the biggest variable in a budget is, the funding side. If I could tell an organization exactly to the penny what their funding would be for the next 5 years, budgeting would not be that difficult, and so we got to show this. But Jeff, I think the other thing, Paul and I talk about this a lot. I mean, Murphy's Law is our religion, right, Paul? You got to plan for when things might go sideways. And banks, but board members too, feel more comfortable that you're considering things and you're not just saying, well, we're waiting. And then that information, Paul, you do this really well, is you use that information to be proactive. You can reach out to a funding source that maybe you think is a little bit, for some reason, you're not as confident as you were 3 weeks ago. Now, we used to say 3 months ago, right, Paul? And I think there's a big benefit for us finance people to be proactive and reach out.
Yeah, and we actually got a question in the chat too that alluded to if today's federal grant funding environment, where an entity can go from 50 million of active grant funding available to a situation where federal draws are not available in 24 hours. So if we have that scenario and we have limited reserves, what do we do? I think the answer is we have to evaluate the reserve situation and think about what's sustainable.
Exactly, and I do want to make a statement, Paul, and help me out with this. A pause in funding for a lot of organizations is almost the equivalent of a turnoff. Because if their cash flow and they don't have operating reserves and their situation is really tight and they have a concentration funding risk, a pause can virtually turn them off. And we've already seen that already. I know you and I, Paul, were discussing that in the hallway the other day.
Yeah, I mean, the nature of how a lot of these organizations operate being cost reimbursement based. And for those, I know a lot of you are familiar, but for those of you who aren't, that's a situation where we're incurring costs in advance of getting reimbursed. So the pause can be very problematic. And that's why the cash flow analysis is so important.
And to be out in front of it. And I think, Jeff, what I wanted to get your comment, and then maybe we'll go into our next section here, but we're going to be talking about banking a little bit more, is I think the worst thing, Jeff, when I talk with all the bank professionals over my career, they don't want surprises. They don't want you showing up at the door and say, oh, we need a line of credit. When do you need it? Yesterday. Those are the words you don't want to hear. But if you've had an ongoing relationship and you've and you're talking on a regular basis, right, Jeff? That's a big difference.
Right. I think surprises are to bankers like what kryptonite is to Superman.
Exactly.
It's not appreciated. I mean, we're working in a world where we want as much certainty as possible. Obviously, the topic today is how to navigate uncertainty. And when the bank is lending money, they want some type of consistency. And I think that's where the game planning or the gaming of the budget comes into play, where you do the best case, worst case scenario. If you lay that out to the bank, that really helps with a roadmap in providing the bank with what the future could potentially look like. So I would echo that and say, yes, we do like certainty, but I think you can overcome that with some assumptions and communication.
So when we get into the banking relationship, Paul and I would like to explore that a little bit more. But Buu-Linh, I thought that we saw there was one or two other funding questions you wanted to get at.
We do. But before we get to that, Mike and Paul, we've spoken before on previous presentations. And I think one of the things that we talked about is how important it is to collaborate. And when you're talking about, funding sources, I think, when I work with nonprofits, many times you see organizations operate more sometimes in silos. You've got the finance team, and then you've got the program team, and then there's a separate development team, right? And I think that in these times, as we're working on, doing more frequent forecasting, I think it's also really important to collaborate and work together, making sure that left hand is getting as much information as possible from the right hand side. And that collaboration, working together and not doing the budget or the forecasting in silos, I think, is important.
I think you're right. I mean, my quick comment on this is during difficult times or volatility in general, even in the positive direction, it's not the time to go silent. And I think you always would get back more information by reaching out. And I'm always scared of the organizations like, oh, we can't put this information out because it's negative. And I think you lose people's trust and you lose feedback. I mean, Paul, right? You were talking about situations where you got to get the team involved.
Yeah, I think constant communication is the best strategy here. And, just ensuring you have that culture. The culture goes a long way to fostering that.
Exactly.
I agree. And I think in terms of fundraising, that has to be a culture that everyone has to put on their, fundraising hat. It's not just on specific individual. I'm gonna move forward to the next item here. There you go. So our next item here is what financial tools and reserves can help cushion the blow during funding interruptions.
Well, I don't mean to keep jumping in, but I think there's something Paul and we're just presenting on this last week about operating reserves. And you got to remember, operating reserves have 2 points of view. They're there for short-term disruptions, but more importantly, they're there as working capital for future support of financial health and to support the organization as it grows and all those kinds of things. And you can't bleed off into these reserves. And Paul, I don't know where this is going, but I do know one thing I would bet the house on. That, to me, short term is 3 months or less, maybe 5 or 6 months. We're already almost 3 months into this. We should be trying not to use operating reserves at this point, is my opinion.
Yeah, I'd agree with you. And I think if you find that you are dipping into those reserves, then maybe it's not that it's the rainy day, but that your situation has changed and we need to reevaluate the path moving forward.
That's a good point. And if you are dipping into them, figure out a way that you can wean yourself off. I mean, funding can turn off like a light switch. And most organizations, 70% of their expenses are in staffing, labor. That's a tough thing to adjust. And so we were talking about this in a presentation. We call it the weaning off, where we set, in quarterly basis, over 3 quarters to, something happens, we're using operating reserves, but define how much is available and then wean yourself off over a 2 or 3 quarter basis to the point where you've been able to rebalance a temporary or new budget to follow. Otherwise, that funding will it'll disappear. I always like to say, Paul, I've seen organizations take 20 to 30 years to build up operating reserves. In a situation like this, they can blow through it in 20 to 30 weeks, and it's gone.
I'm just curious, what about endowment and, tapping into, I don't know, every endowment has their own policy, but maybe looking into if there's a way to tap into the endowment to provide some of that funding. Is that something to consider?
I think you have to be very careful and know there generally are two types of endowments. One is board designated, which means it has been designated by your board of directors, and there's likely more flexibility there. That being said, there's still probably rules and parameters for approval. So that's one scenario where maybe that's possible. If we're in a donor restricted endowment, which means the donor has restricted funds either for a temporary purpose or in perpetuity, that's a big no-no. And you don't want to do anything with that unless you get legal counsel involved and there's other situations. So I think you have to be very careful if you're thinking about that.
And Paul, I would agree also that here where we were sort of downplaying gap and compliance, but when it comes to restricted funds, now it's at the top of my list. You have to be very careful and all that. But there is, and you got to be careful, and Paul and I aren't saying that you should, but you could consider just going back to the donor on these endowed funds and taking a look at the allowability of how the use of funds. But if you can reach out, again, confidence and trust, and that's why you should be talking to your donors all the time. So when something like comes up like this, they might be there for you, and the donor can then change the restrictions, right, Paul? But we need to go ahead and document that and make sure we do it the right way.
Yeah, but that can be a very time consuming process too, is what I would add there. That's not something where it's going to happen overnight and you're going to get the funds. You're going to have to go through many steps, talk to many people. So I would just keep that in mind. If you're thinking to that as a short-term fix, it's probably not a short-term fix.
But you want to get those lines of communications open, as we were talking, as quickly as possible. Because again, just like Jeff and the bank, you don't want to surprise. I don't think a donor wants a surprise either. And they're there. And so I think it's always speed of communication, Buu-Linh, as you talked out. In periods of volatility, you don't want to go dark. You want to almost err on over communicating, especially starting with your board and your major funders.
I know we're going to talk about board engagement in a few minutes, but what about the board designated reserve? I mean, is it possible to maybe, tap into that, assuming, we'll have to get back to the board depending on what type of reserve that is, right? That is reserved by the board. But couldn't that be a possible funding source?
It's possible. I don't think you can say anything in unilateral terms. It's going to depend on the policies and the board and that sort of thing, but it's possible, sure.
And to echo what Paul said, it's possible, but it's still a designation, and you got to honor that and know for your organization what are the procedures to, one, communicate, two, to undesignate or get an expanded use of the funds. And like Paul said, it doesn't happen in minutes. You got to plan for that. And depending on what state you're in, do you have to have a board meeting, right, Paul? Sometimes it just can't happen with a few emails. I mean, that's a major governance, compliance issue that could pop up later on.
When I've seen nonprofits step into their endowment, it's usually when they have exhausted all other resources. And that includes maybe monetizing an asset, a facility, a piece of property, do a sell lease back or some type of arrangement like that, or really try to expand on other intellectual properties. If you're a nonprofit that sells hats, T-shirts, those type of things, there's elements that you want to try to control on both the top line and on the expense side. Renegotiating your contracts with your vendors. Take a look at everybody from your payroll provider to your merchant card provider, and go back out to the market and rebid those services again. I know talk about relationship for your bank, and you may have relationships with these other vendors, but at the end of the day, you really want to do right by the organization by having a bid schedule, whether that's every 2 years, 3 years. Now may be another time to revisit that as well. But the endowment and tapping into that for operating capital, I really think that should be after you've exhausted all other options.
Yeah, and just to put this out there real quick, Paul, if you could help me here for a sec. I've seen organizations get sideways where they said we didn't tap into the endowment, we borrowed from it. But a few times it's gone to court cases for me, it showed that they actually used it because they either weren't paying, they did it without a formal agreement, they didn't pay a market rate of interest. And they showed through a correspondence, in the cases I was involved with, that it wasn't a loan. They were just selling it as a loan. They used the funds.
Yeah, I mean, I'm not a lawyer. I don't pretend to be a lawyer, so I'm going to steer clear of opining on this. I would just say what you're saying shows some of the potential perils of doing this path.
That's the point. Yeah, there you can't just and we've seen where organizations got sideways because they virtually dipped into those funds from a cash flow perspective, Paul. Because all of a sudden they've burned down cash flow below protecting restricted funds.
We do have one more items here under this topic. So how can nonprofit diversify funding sources to reduce reliance on government grants?
That's the $1 million question.
Yeah.
That's a culture thing, right, Paul? There should be working.
I wish there was an easy button to increase fundraising, right? I mean, I've gone to so many nonprofits just from a board member role, and they say, "Hey, I want to start fundraising," and that's great, but it's going to take time, effort, and resources. I think it's looking to the community and seeing what's out there and looking to other private options. Knowing what we're seeing in the federal landscape, I wouldn't be optimistic about more funds being released there if I had to make an opinion.
And Paul, I think this goes way back when I even go back to when I was studying accounting. It's like organizations never pay attention to, concentration funding risks. It's one of the earliest risks we learn about, right, in auditing, Paul. And there's not an exact formula on it, but I think the organizations that, during the times when that pipeline of that type of funds have been easy to get, quote unquote, and all, they still should have been looking to diversify funding. It's like diversifying your own investments at home and stuff. And so we don't want to make anybody feel bad, but I think you're always looking for that to lower that concentration risk. And if your organization does have a concentration, it's not necessarily bad, is that you should be doing scenario planning.
I have seen a few nonprofits take a facility that they're operating out of if it's not being used during certain times of the week, they will allow other nonprofits. So from a collaborative standpoint, they basically go out to sister organizations and they say, hey, from 4 to 7 on Tuesday nights, our space is open. We'll charge you X dollar to use the space, and that's like an additional revenue source if you've got a facility that can be opened up for other nonprofits to use or other organizations to use. That's a good way of diversifying the funding source. And then you have to think too, if you're going back to your donors and going back to the people, they're probably going to be in a very similar situation. The market's not only impacting the nonprofit space from a funding standpoint, but a lot of times giving is correlated to how their personal assets are performing. And so there's probably going to be a pulling back as well. So I think this is a time when you communicate early and often. And those people who have been with you for a long time, you want to wrap your arms around them and share your story as much as you can about, hey, this is great that you've given. That's helped for operations. But now we're looking for you to help sustain us through this uncertainty.
Hey, Jeff, you bring up a good point. I think we could end here on this part, but fundraising is never easy, but it's harder during negative or disruptive times. And so that, some planning when the times are good, right, it comes in. And one of those, Paul, that, you and I've talked about in our presentations is building in some options where possible on restricted funds, where the agreement, we come to the end of restricted period, there's funds left over. Can we use it for another source? Is there without putting the compliance sideways, is there a way that we can build in on the front end, some steps that restricted funds might be able to be used other ways or, through some sort of reporting mechanism. But to go out and, get into new areas is something that, organizations should be constantly thinking about that, if you don't evolve, you die. You have to constantly evolve your funding as well as your programs.
And one more items I was just thinking about is maybe as appropriate, maybe charging for certain services that you might not have charged in the past. That's maybe something. It could be training or certain services that could be a funding source as well. Expanding on that.
But also, I hate to be a negative person, but if you think back to COVID, there are a lot of funds available, safeguarding funds that we don't have this time around, and so people should be aware of that. And they're probably not out there, right? As I haven't heard of any, Jeff, Paul, anything that was anything remotely related to PPP funds or ERC, or there's just no stimulus mention of anything. So people need to, really get on the horse fast.
Okay, so we're going to move to the next topic. Banking institution support. How can banking relationships be leveraged for strategic planning and support during crisis?
Yeah, I touched on this a little bit earlier, getting back to just what every bank in America will tell you all the time. They'll say, we're the relationship people, we're about serving our community. But the reality is that the rubber meets the road when you actually see if they're actually out on the street and engaged with organizations and actually helping them. So how can the relationships be leveraged? Well, if you've never had a relationship and you're entering this time, you're obviously in a kind of a tough spot. However, if you do have a banker that is specific in the nonprofit space, they have a bank that it's in their DNA to support organizations, now would be a great time to reconnect and share your plan with that individual. Because, like I said, your banker is really an advocate for you internally. And the more that they can tell your story articulately internally to the bank, what most people don't realize is the banker is actually in a sales role as well internally to credit. And so the better we can tell that story, the better we'll have a higher degree of success, obviously, in helping. So the relationships are very important. And also bankers that play in the nonprofit space can see good, bad, and ugly of other nonprofits and what they're doing in the market. And those best practices can sometimes be shared once they hear your story, once they understand what you're going through, and they can provide advice that's free that I think is really helpful.
Jeff, I was with some people, it was a couple months ago, and I met this one person on an airplane who I had known, and we started talking a little bit about this, and her background was in banking. And at the end of the day, she made a comment that really stuck with me, is that when it comes to a nonprofit and the banking relationship, you should really stay in touch with, and we wrote a lot on the SC4N website on this, staying in touch with your banks, because banks are a great network, like a consulting network. I've gotten more information, Jeff, from people like yourself sharing that and know you if you're in regular contact. But the comment she made to me, and Jeff, if you could expand on this a little, she says, when a nonprofit approaches a bank, especially around financing, that nonprofit needs to take on a business approach and not a nonprofit approach. And, they're not going to loan to you because you're helping 6 children. What they're going to loan to you is based on cash flow, analysis, confidence on your financial reports, repayment of the loan, and all these things. And just because you're doing amazing things out there, it's not going to generate a loan. So she said, nonprofits need to act more like for-profits when they're talking to their banks.
I can agree with that. I think that the nonprofits that really engage banks well are the ones that typically have a diverse board that includes a banker, an accountant, someone with a little bit of financial IQ, because they can speak the language of what the bank is interested in hearing and what they know. I've not met a single nonprofit that's in the business of not doing good in the community Everyone is doing amazing work. The operational side, the mission side of most of these organizations are A plus across the board. Where I do see some mishaps is when what I would consider basic financial requests are made about forecasting, road mapping for the bank, the future, which I know sometimes is difficult. They just kind of look at you like deer in headlights sometimes, and you kind of got to go back and walk them through it. And it expands beyond the banking relationship. It matters who you work with from an accounting standpoint as well. So accountants, your accounting relationship, your banking relationship is there, but then it's also goes back to the board dynamics and how diverse the board is. You have people with a big heart for the organization, but also find people that have got a little bit of a financial IQ and have maybe borrowed money as well. They'll be in a really good position to help.
Yeah, and Jeff, if you could comment, I think I try to get people like yourself in front of the staff and the board, and then let them understand. They just think that banks are, we'll just request a line of credit. Sometimes that can be the worst thing for an organization because it keeps them from, making some critical budget decisions that maybe need to be made or something. And other times the lines are wonderful. We have seasonality, we have temporary disruptions. But I think I know probably over your career you've talked with boards, but it's less organizations. I think it's a wonderful resource to get yourself, your bank relationships in front of your boards, in front of staff, as well as
there's no substitute for site visits and meeting with staff, even meeting with clients and people that have benefited from the organization. Again, it goes back to the storytelling aspect of banking and the banker's ability to translate that internally to get results and be able to act on the behalf of the organization. I think that's incredibly important.
We have another item here under banking. This up. Okay, so what new financial products are available to help nonprofit weather funding gaps? I think, Jeff, you spoke a little bit about this earlier.
Yeah, some of this stuff is not new. The concept of bridge loans typically happens more in the consumer side of the world, where if you're selling your house and you want to have a down payment on the next house, sometimes people will do a bridge loan or a second mortgage on that house as a basis for providing cash for the next property. Bridge loans, in the sense for nonprofits weathering funding gaps, that's really, there's got to be an understanding of the forecast and when funds are expected. I've done a handful of these type of financing options, but it's basically the bank wants to see the trend lines and the consistency of a grant that's coming in at a certain period of time. That provides some predictability. If you have something that's forecasted to say in September of this year, I've got one or two nonprofits that we're funding some things for before they get funding in September. So there's bridge loans that can help with that. Lines of credit are typically funding your just routine operating capital needs. Think just your payroll funding, meeting rent obligations if cash flow is tight in any given month. I really like the idea of the officer guidance line. That's a very old school product. Most banks would probably say, what are you talking about when you bring that up? But it is a product that you can utilize. I like it because you basically underwrite the organization based on where they are, space and time, and it plays out a scenario that if something were to happen, a nonprofit does have to weather a certain type of funding gap. If the stars are aligned as it's laid out in the OGL, there's no questions asked, and the funding can come in and act. The OGL could act a lot like the bridge loan financing as well. So I'm a big fan of that. I wouldn't say there's anything new in the world of lending. It's kind of been this way for a long time. I think the timing for when products get used, that's what makes this a unique period. So I think they're the same type of products, but the utilization of them is kind of different right now. And as far as other products go, there's the lending side, which helps with the funding side, but I also really tell people, take a look at your deposit account structure. and how the accounts are actually set up. Are you getting interest bearing on your working capital? Do you have a sweep that funds over from a money market into your operating account? Any zero balance type account structures? There's ways that you can set up the accounts to where it minimizes fees and it maximizes the amount that you get on the funds while they're sitting idle. So it's kind of a two-pronged approach, lending and on the deposit side.
Paul, you made a comment, and we're been in the compliance world our whole lives, but there is a non-GAAP thing here that goes back to support what Jeff was talking about, which is, I think, super critical, the cash flow projections and doing cash flow projections, looking at things from a cash point of view, where because we get so focused on budgets and accrual basis. But I think you've got to look at, like, the next payroll is less than 2 weeks away all the time and such.
Yeah, I think, as I mentioned before, cash flow analysis is critical, especially for those organizations that might be less capitalized than others. And I think all the solutions Jeff mentioned are great. The one other item I'd add for nonprofits to pay attention to is many times these lines of credits or other products have covenants associated with them. And just to make sure from a compliance perspective that you are tracking compliance with any debt covenants that you have.
100% there. And Jeff, I think you would agree with this statement. Without a cash flow projection, I don't know if you're going to get off first base, right? First base, you reach out. But if you have that cash flow projection, don't you feel like differently when you're talking with them versus, oh, you need to go back and do this now? It's like, oh my God, these people are not thinking about the future.
Yeah.
So cash flow projection is huge.
Well, the one thing that repays debt is cash. And so having some forecast that shows what the future would look like and the assumptions that are baked into that cash flow as well. I think that's the big key is, I've seen a handful of nonprofits put together cash flow forecasts, but going one step further and just doing little line items about the assumptions that are going into each one of those line items, that really provides some color commentary to what you're providing to the bank. And it does help move you from first or second base.
Yeah, and then that gets back to the funding pipeline where you can explore a little bit best case, worst case, and share that information with the bank and say, hey, the ideal scenario is we haven't had a disruption funding, but we're worried about something in 6 months. And you feel totally different, Jeff, right? If we come in and say, hey, we're sharing this information. We have a major grant. It's up in 6 months, might not renew. Here's what we look like. We might need 3 months to bridge, replacing that or something. And then you can show it in the cash flow. But that funding pipeline is where you can show something like that.
Right.
Yeah.
That's exactly. It's contingency plan. A lot of organizations have contingency plans for fires or natural disasters or floods or anything. I like to think of this as creating a financial contingency plan that basically, do an if-then scenario about things that would happen if a grant doesn't come through at the time period that people think, and you need support from a bank during that period of time. Well, let's figure out what that looks like from a cash flow standpoint and how long we could maybe go interest only until the next year when there's some other fundings that are going to be coming in. There's ways that you can do that, but basically thinking of this as the rainy day scenario and having an if-then analysis.
And Jeff, before we come off this section, I think we should repeat ourselves. When you go to the bank, when you're like their last resort, there's almost zero chance it's going to work. You wait till the last minute.
Yeah, I'd hate to say it's I'll give you the canned banker response, which is it depends. But I think that early communication is better. Getting back to the no surprises thing, having a bank and a banker that knows your mission, knows your story, can be a believer and an advocate for you internally is very important. If you do find yourself in the crunch scenario, that's when I would say leverage your board, leverage other partners that you may have, large donors that may have good relationships with other banks, have them advocate on your behalf to help bridge that gap. of time.
Yeah, and during these disruption times, the lines get long. Good times, people aren't asking for financing, from a nonprofit perspective. During these tough times, you don't want to be in the back of the line. You want to be in the front of the
Right.
line because,
Right.
the bank recognizes you, they trust you, they've been working with you. And, it's like, oh, I haven't heard from you in 2 years, not good.
Right. Yeah. Banking's easy when things are always on a steady incline, right? It's you earn your stripes when it's time to get in the trenches and actually work with people that are in a difficult spot.
No, absolutely. Buu-Linh, maybe we can advance to the next topic,
Yes.
knowing we only have about 10 minutes left in our presentation.
So on the board engagement, we have how can nonprofit leaders keep their boards aligned and informed during rapid changes?
This is a really good subject. I think we stated this really earlier. I err towards over communicating versus under communicating, even to the point where Paul, I've used this a lot. We learned that grant that we thought was coming in the door might not be. The knee-jerk reaction, let's watch it. I think you get out, even if you don't have an answer, and let your boards know that this is a material amount. Wouldn't you agree, right? I think you let them know, even if you don't have an answer right away.
Yeah, I think it's okay to message knowing that we've identified this issue, we are analyzing this issue, and we don't have the answers yet. But just letting your board know that this topic is top of mind for you, that really fosters that sense of trust and ownership.
100%. And I think you can start to get, some feedback. But if there's dead air space, that's where people start thinking, they're not communicating. There's some other story here, quote unquote, the conspiracy theories all start to play in. But it's just a little bit of a human nature thing. So I think you need to get out there. There's 3 layers with a board, Buu-Linh, that I think is interesting. Paul and I have talked about this. You can over communicate with the board, so you got to think about this. There's situations where you're reaching out to the president, the chair of the board. There's situations where you need to, it's maybe a little bit lower key, but the whole board needs to inform. And then there's other times where, if we're putting out financials or we meet every other month, that we can just tell them during that time. And you got to sort of see, is it that, emergency? I don't think you ever reach directly out to a full board. I think when it's that level, to me, I'm going to a board chair or a treasurer, an officer to start that, and then see if the officer agrees. I mean, Buu-Linh, what do you think about that? I think I always try to think.
I agree. I think it's important. And also, I think that as you're making decisions, how is that impacting the mission? Wanting to make sure that it's in line with the mission of the organization as well. And it's, as you're making, key strategic decisions in terms of how the what are the plans for the organizations, I think that is also important because you could essentially, I think the board needs to know that whatever we're doing, it's being tied to, the mission of the organization.
The tougher one, I think, is, like if you learn that a grant just got pulled, I mean, that's going to always be in that quick talk you're going to get out. It's those other ones where you start to say, well, this might happen in the future. That's where it gets a little trickier. And I think you should have a plan in place to define that. And, like, here's where we need to reach out quickly. Here's where we know a meeting is 2 weeks away and it's okay to, talk about it then, just to, go through that. But I think
other thing,
yeah, go ahead.
I was going to say the other thing to note is that the board also are coming in with different experience. And so sometimes I find during these times, as you're communicating on the financial side of, obviously the board has some sense of how things are going, but if you're providing financial information, how you're presenting it also matters too. And so, providing them with providing the information in such a way that, the board as a whole understands. So if the state of the finance, I think it's also important how you're presenting that information.
I think you're right. In the dashboard, to me, you know how you have a gap set, right, Paul, of financial statements that are full set of financials, but that dashboard on top, can be reformatted, something that we need to watch. That's what the dashboard's there. To me, it's like the executive summary of the financials. And we're not changing our financials, but in the dashboard, you have ability to help people focus on a changing trend or an issue like a grant being pulled and be able to watch it.
Yeah, what comes to mind for me there is knowing your board and knowing what modes of communication and what information helps them to shape their decisions. And that speaks to the importance of everything we've talked about today in terms of knowing your board, developing those relationships, because in times of peril, knowing that individual can go a long way towards coming to a positive resolution.
A lot of the finance departments, Paul, they have so much work and they want to get the reports out, and they're so happy at the end of the close of each month. They don't want to consider a change to the dashboard. But to me, the dashboard is more a picture print. It's more artistic. And they should sit back and say, just like Paul said, is it meeting the needs of the board and your needs to communicate with them?
Yeah, I totally understand. I totally agree with Paul's comment about knowing your board and understanding what background they're coming from. I was talking to another nonprofit. This is a large nonprofits, and she basically said, I throw the entire concept of restricted and unrestricted out the door because no matter how many times she's kind of explained that, it's like, the tears in the lights there, the board is just not getting it. And that's okay. You could communicate this, the state of the organizations without getting into that technical, the technical terms of unrestricted and restricted and release and all of that, right?
Yeah, again, just knowing what terminology resonates with them is extremely important. Okay, we probably have time for one or two more questions.
This is, let me check to see if we have questions. Well, this is the last item. What can the board do to help during these times?
This is a good question, Paul. I think you alluded to this. Inventory your board. You're supposed to have a diverse board for a lot of reasons, and they bring different things to the table. And the board is not staff, but we're all managing together. And I've seen some board members, the 20/80 rule. Well, there's 20% of board members can actually help you solidify a funding source, with a call or help in certain areas. But I think you got to be careful what you ask board members to do, but utilize that resource to the max.
Yeah, I would just add that oftentimes the board is comprised of voluntary members, and these are individuals that have a day gig, a W-2 job, and so they're doing this on a part-time basis. The more you can scope down and almost bullet point out the specifics of what you're facing right now and what the needs are, and to Michael's point, identify, take inventory of your board and their background, skill sets, where they work, and try to align as much as you can what the needs are with what you think a specific board member can contribute. I can't tell you how many times I get off a board call and I'm like, that was great, but I don't know what I'm supposed to do next. And the more that you can scope that down, bullet point it, make it concise, the easier it will be. And I think you'll get some positive results with some action items.
Yeah, I agree, Jeff. And most board members do want to find a place to help them to contribute. And there's different, every board member is different, and there's different ways to help them engage. So the key word there is engagement. And during tough times, not every board member, but a lot of board members are willing to, put a little more in the game of their time and effort, and maybe even their dollars.
All right. Well, we only have about a couple of minutes left. And so I'm not sure if there's any questions out there, but if you have questions, maybe afterward, feel free to send them over to me. I'd be, happy to get a response back to you. Actually, I don't think this was recorded. I thought this was recorded. I apologize, this wasn't recorded, but if you have questions, we can certainly send it over to you. We usually do webinars. We do primarily webinars. This was a little bit unique. We did a roundtable discussion. And so we just thought it would be important to do that, given that, we support so many nonprofits, and we thought this would be beneficial to the community. So I'm going to conclude this session, but before we leave, I wanted to thank everyone for attending. I especially wanted to thank the panelists for being here and providing this level of expertise to help the community. Really, really appreciate it. And like I said, if anyone has any questions, please feel free to send them over to me, btran@jmtconsulting.com. Thank you so much. Thank you.
Thank you.
Take care, everyone.